And we are live. We are live. Let me double check the Discord. Got it. Yep. That's sent through. Okay. Ladies and gentlemen, TWB family, thank you guys for making the time. We got Charles Dietz, brother. Thank you for coming through. I know Saturday isn't the best, but look who we have, guys. We have my brother, my friend. Like the guy is a goat in terms of open door research. We've got Tyler Okland. Okay, but before I introduce our analyst, our speaker, our friend today, I just want to make a quick announcement that Tyler is a surgeon, so he's on call right now. So if he does get if you hear a lot, well, actually, they don't use beepers. In the UK, we still use beepers sometimes. But if Tyler does have to make a rush out and go to the hospital, it is what it is, guys, and we'll catch up. But it doesn't expect anything. He's informed the junior doctors that he's busy. But if it's an emergency, he will be contacted essentially. So thank you. But my brother, you see the chats, Tyler, on the side. Can you see the guys coming in? So we got.
What's that?
Can you see the comment section? You can see the comment section.
Yes, I can. Yes, I can.
Perfect.
Let's see.
Perfect. So GWB, at the end, we're going to do a Q&A session. So I've got some of the questions ready for Tyler, and he's going to share with us and teach us, and we're going to learn. And then, so keep your questions towards the end, or if you do want to comment, you can comment, but we'll get back to it. But before we dive into that, I want to give Tyler 20 seconds, okay? For those who have been living under a rock, who may not know who Tyler is. Tyler, if you don't know, can you please introduce yourself and your experience with investing and your favorite sectors? People want to know what are your favorite sectors to invest in.
Yeah, sounds good. Thanks so much for having me. Super excited about this. I was just telling the boss that for me, I'm a surgeon, so I'm at Stanford Hospital right now. I'm in my final year of training, and all day is medicine and science. And so I originally looked into finance and investing as an opportunity to sort of break things up and challenge my mind in a creative way. I've been an entrepreneur my whole life, and so I've always had an interest in business strategy and sort of that thought process. And over the past 7 years or so, I've been investing a small but now growing portfolio of funds that I earned basically through consulting when I wasn't working. Over the past year, I started a Substack called The Operator, where I write about what I think are the most disruptive technology companies in the world. And the specific sectors I'm interested in are fintech and real estate, so prop tech, as well as data. And those are kind of the areas that are my core competencies right now.
Nice. And I'm going to have to plug your Substack, your Seeking Alpha page. Everything's going to be in the description. I've already shared it as well. Discord members already know, but just in case people are not sure, it will be in the description after the live stream. So, okay, Tyler. So I didn't even know you were into business initially. So you've been an entrepreneur. Like, do you have any businesses that you run yourself then?
Yeah. So throughout the first 4 years of residency, I ran basically an online consulting service. So it was basically like advisors and tutors for medical school applications, dental school applications, which was really great because we were able to help a lot of students gain admission to colleges and medical schools, graduate schools. And that process can be very challenging, labyrinthine, some might say, and oftentimes you just need someone to show you the ropes, because otherwise you just can't make it in. We were able to do a lot of charity work as well, so we were able to use a lot of the profits to help underrepresented students gain opportunities that they maybe otherwise wouldn't have. So that was a lot of fun and rewarding, but it was something that we we weren't able to continue over the past year. It's just something that you need someone to be doing 24/7, and I couldn't do that. Plus residency and writing, and I love writing too much. So
yeah. I've been trying to convince Tyler, because he's a fantastic writer. If you read his articles, I mean, I found you when I was doing my due diligence for OPENDOOR, and then I came across your Substack. I read that article and I was like, you write different to a lot of the other analysts that I've read, because you tend to use like Greek mythology sometimes, which I thought was quite unique. Like that really stood out for me. And then you really are critical. Like a lot of people are very they're biased towards what they're researching, but you do put in arguments, so some of the pros, some of the cons in your work, and then you reach a detailed conclusion, which I thought brilliant. So I've read all of your articles. I see Jose knows you're big on unity as well. So there's go open unity. So your work is flawless. And I was like, okay, you're a person, you're an investor that I need to bring onto the channel that we can learn from, or Discord members can learn from. Pick your brains if you don't mind. And then we can all roll as investors. So I appreciate you, brother.
Thanks so much. Thanks for saying that.
When you're talking about your business, the previous business, I was thinking about TDOC, right? Because there's a few people that are bullish in TDOC in the Discord. I'm not going to name names. They might be in the live right now. Just, are you bullish TDOC before we get into the Q&A?
Yes. So short answer is yes. It's not one of my core conviction picks, but it's one of the 6 stocks that I hold.
Nice.
I'm a little underwater on TDOC at this point, but I think long term it's got a huge future.
Love that. I mean, Jose, I can see you in the chat, bro. There you go. See, that's all we needed to hear. Okay, right, brother. So let's get into the meat now. Okay, I wanted to ask. So, like I said, I've read your articles, love your articles. I wanted to find out, like, what is your investment approach? Like, how do you approach investing? Because everyone's different, everyone's unique, everyone has different goals, investing time horizons. Like, can you give us a detail of your approach? Like, how do you identify new opportunities? Where do you find these companies that you write about? Like, what is that approach like for you?
Yeah, so I think I have 4 criteria that I really apply to every equity and crypto investment that I come across. And crypto is unique because these policies don't always work with crypto. But I think it gives me a good scaffolding for how to think about an investment. So I guess in order of how I value them from least to most. So number 1 for me is visionary leadership. I want patient world builders that so believe in the problems that they're solving that it's contagious, that they're able to build a culture. The kind of people that would be insulted at the proposition of a takeover or an acquisition. I mean, people that want to die working at this company. That's the framework that I want, and I think that's pretty clear when you start to listen to interviews and podcasts. It's pretty easy to divine which leaders are that way, which ones are just built different, and that's the first step of all of my research, which is another talk, which is I listen to every podcast, I watch every interview, and just start piecing and quilting together their strategy. Number 2 would be moats and flywheels. So I'm a big fan of flywheels. I love positive reinforcement loops. And in regards to moats, I'm referring to 7 powers. So Hamilton Helmer's 7 powers. There's 7 moats that a company can have, and that allows you to have a resilient, defensible business. I wrote an article about all 7 and Palantir earlier this year. But I think that having those features makes a business that's going to outperform for decades. Number 3, infrastructure players. So people call that picks and shovel plays. I tend to call that owning the middle. But the concept there is that if you can build horizontally. If you can add surface area to your products and in your business reach, you gain market share, but you also gain ubiquity. And once you have ubiquity, you can really flex that pricing power muscle. And so all of the companies that I'm invested in are infrastructure players. And I preferentially value those, I think, over Wall Street or peers. I'm just really looking for the company that's going to provide and internalize all the services so that they can be the gatekeeper, the road that everyone has to go through. Brilliant. And then last, and this is most important to me, is a misunderstood narrative. And this is particularly important to me because I'm a storyteller, and that's what I do with the operator. That's what I do when I'm looking at business strategy. But if it's a misunderstood narrative, and by that I mean that it seems opaque, and the common sound bites that you hear everyone spouting seems like everyone gets it, but really, if you take a second to look a little bit deeper, that isn't the thesis at all. And in fact, it's not even confusing. You just needed to go a little bit deeper and suspend your bias for a second. These should be secular trends that can be explained to a 5-year-old, like Uber, for example. And Uber's in a mess right now. I don't want to get into Uber, but back in the day when Uber first came out, it's like, hey, do you want to stand on a curb and wait for a car to drive by that you can get into and have no control over the interaction, and then you know it's expensive and you have to tip? Or do you want to just tap a button on your phone and someone comes in and customer service is regulated? I mean, that's why Uber went like this. Uber and Lyft, I mean, they created a duopoly. That's easy to explain to anyone, and it's obvious. It's the same thing with Unity. Do you think the world is going to be more digital in 10 years or less? I think it's going to be more. Okay. Yeah. Who's going to build those experiences? It's Unity. Yeah. It's a very clear thesis, but it's not what people are necessarily saying. And I think if a business is misunderstood, it's undervalued. And that's my favorite place to be.
Wow. Yo, okay. That was quality. Okay. Wow. Okay, right. So, when you started talking about misunderstood narratives, immediately I thought Palantir. I immediately thought Palantir is one of the most misunderstood businesses on Wall Street, in my opinion. I want to circle back to visionary leadership, right? Because obviously in the news recently, we've had Elizabeth Holmes, who's been convicted. But man, like, I've read the book. I'm not sure you read this book. It's right here, Bad Blood. It literally tells her story and like how she was able to convince, Walgreens to get the products in there. She got her board of directors, her board at the time were like A-list multi-millionaires, billionaires. They had family offices invested. Like, and when you look at some of the interviews, when I go back, she did sound very visionary, saying like almost messianic in her pitch. Do you know what I mean? Like, totally. Just one drop of blood and that we can get diagnosed whatever in this etc. So my question is with regards to visionary leadership, how do you tell, I guess, the real from the fakes? Because anybody can tell a good story, right? Like anybody can be mission driven, but how do you differentiate the real from the fakes, if you can?
No, that's a great question, because you don't want to be the guy holding the bag when it turns out that all those promises were optimistic. So I think for me, and OPENDOOR is sort of a perfect example of this. Is I'm looking at operational execution, and so you think it sounds like they're trying to be the Amazon of real estate. It sounds, I don't want to get too far into OPENDOOR. I know that's sort of at the end of this whole thing. But just as like as an example, I read the quarterly reports. I look at the balance sheet. I see how they're executing and if they're able to meet their promises. And after a few quarters, it's pretty easy to tell, is management conservative or do they sandbag? Are they overly optimistic about their prospects? Or are they right on track and they're actually able to achieve what they're setting out to? And that's why I don't really buy IPOs right from the get-go. I like to see a quarter or two first of track record just to make sure that they're continuing to execute. But you take a company like OPENDOOR, I don't think there's a single company in the world that executes better than them. I mean, they're fantastic. I'm happy to get into that more deeply later on, but I think I can back that up.
I think you hit the nail on the head there. Operational execution, like that's important, because especially in 2020, you know, Trevor Milton, Steve Burns from Workhorse Ride, you know, they had all of these great visions, and they, you know, the presentations, the investor presentations were off the hook, you know, with all these crazy numbers. But if you were just patient and waited to see them actually execute on their promises, like that's how you can differentiate between the fakes from the dreamers and the actual executioners. I think that's brilliant. Yeah. Okay. I think okay, so on misunderstood narratives as well. Okay, so I'm reading Peter Thiel's 0 to 1. Okay, fantastic book. And what you're talking about, I'm reading I've finished a chapter on secrets, you know, and something like Uber now, it's obvious to us, like you said, do you want to stand on the curve and wait, or just want to, you know, log into our app and get someone to come there when, you know, when it's time. It seems obvious, but at that time it was a secret in a way, like hidden in plain sight. Again, he uses Airbnb as an example. You know, people have spare rooms, you know, and at the time, you know, people were paying crazy prices, hotel prices, but then Airbnb came along, revealed a secret, and blew up, right? But it takes time because it's misunderstood. It's going to be loads of red tape, you know, like with Tesla had a lot of red tape. How do you manage that process then, from it going from being misunderstood to essentially being loved?
Yeah, that's a great question. I mean, I think you know, the issue with Uber is we weren't able to participate in investing in Uber. I mean, it came public, tens of billions of valuation. So you had to sit on the sidelines while it became loved. So it was basically it had already become the de facto mode of public transportation by the time regular investors like us, retail investors, could get involved. And so there's really not a lot of opportunities to participate in something like that. And I think the things that you have to be looking for. So Keith Rabois, one of the founders of OPENDOOR, like one of his most popular tweets of all time, he's talking about formula for startup success, and he says, find a massively fragmented industry with low net promoter score and vertically integrate. And that's the secret, right? And so taxi driving and public transportation is an excellent example of that. You have millions of taxi drivers who don't all work for the same company, who offer not a great experience, not a great public transportation experience, just like public transportation in general is not a great experience. But if you can bring all that in-house, optimize it with technology and customer service, and lower the fees, then wow, you've got magic. And that's what results in a duopoly. We couldn't participate in that. There are a few opportunities like that now in the public markets where you have this misunderstood opportunity that it's in its inflection point. It hasn't quite hit that vertical slope, and you can tell that it's in that inflection point because of NPS and because revenue growth is absurd. And that's us seeing these things happen in real time, right? And it's such an opportunity, but I mean, again, it's misunderstood. And so the way I manage it is, if my stocks go up, I make money. If my stocks go down, I like them better because I can buy them at a better valuation, and it's better value for me. So that's sort of my take on it.
You know, when I say this in the Discords, I feel like some people think I'm crazy. You know, like why I get excited when it goes down. Like I put like emojis, gifs, and people are just like, what? You're in the red, bro. Like, what are you talking about? But I'm just like, mate, I loved this company at 20. It's now 10. Are you kidding me? You know, but again, because I see the opportunity, I see the vision. And like you say, I love that analogy of the vertical slope. It's like right on the cusp of that S-curve expansion, you know. Okay, so my question is, all right, and this is from Charlie in the Discord. He asked, you know, okay, so that's your approach. That works for you. That fits your investment thesis. But does the Fed Their decisions on interest rates. You know, obviously Jerome Powell's gone from being dovish to hawkish as soon as his job was certified. He changed his mind. I'm not accusing him, by the way. That's just what it looks like. You know, he changed his mind. And you know, people are now talking about switching to a more defensive approach. You know, investing in, like, you know, you've seen a lot of money being parked in established blue chip mature companies that people don't want to. They don't want to know about misunderstood businesses for now. Like, and that's the narrative that they will perform whilst interest rates go up. So does that then change your approach in the meantime? Like, especially going into 2022, are you now looking for more value stocks? You know, recovery plays, like, are you putting cruise lines in there? Or airlines? Does that change?
No, that's a great question. So I want to start off just by saying that everyone has a unique investing strategy. Everyone has different constraints, different financial needs. I'm in a unique position where my entire portfolio is money that I've never seen. I live very simply, although my Californian rent would tell you otherwise. I mean, I all of the.
Oh, you live in California? In Cali?
Yeah, I'm in Northern California.
Because there was a trend, I think it was in 2020, where leaving California, everyone was leaving California. I felt like I was leaving California just from the YouTube videos. I live in London, around London area. So wow, okay, so you're still in Cali, right?
It's still in Cali, yeah. So I'm in Northern California for one more year, and then I'm going to Tennessee for a year of training after that. But basically what I'm getting at is, like, my entire investment strategy is to be a long-term investor. I want to pick companies that I'll grow with, and that I can continue to research, and that I know better than anyone because I've been around for a very long time, and I look deeply. And so nothing about the Fed changing interest rates changes my thesis in any of these companies whatsoever. In fact, some of my core conviction picks benefit from a higher interest rate environment. And it's something that I'll monitor. But I think at the end of the day, at this point, if you are a growth stock investor, the damage has been done. I really don't think that there's too much more downside that we're going to see from here. At least it's significantly less than it would be, you know, in November. And so I think all of that has been priced in. The market tends to do this thing where, especially nowadays, there's like an overreaction both up and down, and then we get back towards a more middle approach. But 2022, 2023 and beyond are going to be the greatest growth years for technology names ever, of all time. And that's not slowing down. Technology isn't getting slower. Innovation isn't getting cheaper. Everything is getting better. And all of the companies that I'm invested in, I think, are standing to benefit from that.
Nice. Well, there you go. I share the exact same sentiment. You know, I'm in a position as well where my portfolio, like, I love the fact that you don't even see it. It's like money that's pretty much retirement. Do you know what I'm saying?
Right.
So I put money aside. I don't need it anytime soon, at least for the next decade or so. Money I don't need. And I think that's crucial, you know, with investors. What retail investors miss this day and age, like, they invest with money that they need in the short term, and that then puts pressure on themselves to see it grow, and pressure on the investment. You're not giving your investment time to grow, room to, you know, to execute, because you need the money now. So would you say then just the people that invest in money that you don't need now, or what would your advice? Well, so not financial advice.
I definitely, I don't want to give financial advice necessarily to anyone. A lot of what I'm doing with the operators, just like, so the reason I first wrote my first article on OPENDOOR was because I was like, no one understands this narrative. All these articles, all these people talking about iBuying and Zillow and Redfin and OfferPad and OPENDOOR, no one seemed to really understand the narrative. And the more deeply I looked, the more clear it was. And so I wrote my first article almost antagonistically. I wanted to kind of put my voice out there is this is what I actually think the story is. But it wasn't so much buy this stock. It was more just, can we clear the air? Can we have a fresh slate when it comes to what the actual truth North Star is for this company? And that's sort of what it is for me now, right? Like I said, everyone's different. Some people trade for a living, and that's crazy, and more power to you. Day traders, I don't understand that at all. And I don't pretend to, and I have all the respect for it. For me and my personal style, I just want to hold. And if I'm holding and not selling, then the money doesn't, there's no downturn for me until I sell. And so these short blips is like great opportunities for me to accumulate.
Brilliant. And that was going to be one of my questions. You think you've already answered it? Like, how do you manage drawdowns? But you've pretty much already answered that. Okay, cool. So before we dive into OPENDOOR, I wanted to ask, what are your top 3 highest conviction investments currently?
Yeah, that's a tough question.
It's like asking you to pick between your children, right?
yeah, exactly. Yeah. The stock that I'm most convicted about is OPENDOOR. That's my favorite child. And the other ones I love equally. But let's see. So the 2 I've written most recently about are SOFI and Unity.
Okay.
And so when it comes to SOFI, I just published an article on this, I think January 3rd. So just this last week. And what I really wanted to dive into is, why are all these companies going after the super app model? And so my article, I talked about how this will be really quick. The idea is that every financial services product has a different customer acquisition cost. And similarly, every financial services product has a different value, right? So if you sign up for SOFI credit card, it might cost $40 for me to acquire you as a customer, and I might make $1,000 on you over the next 2 years. Whereas for like a loan, it might cost $800 to acquire you, but I'll make $2,000 on you over the course of a few years. And so the reason that's important to understand is, if you have a super app model where you have a myriad of different financial services products, you can get customers onto your site or your app or whatever it is with the lowest customer acquisition cost product, and use that as top of funnel to cross-sell them those higher LTV services. So those services that otherwise would have cost $1,000 in customer acquisition, you've already got them in your ecosystem. And so that's the hallmark of the super app model, and why all these companies are pursuing it. And SOFI, I think, is the closest, because it has its top of funnel, low CAC financial products and financial investing, credit card, banking and checking and savings accounts. But then it's lending, it's vertically integrated in lending. And so it's able to just cross-sell those members down the funnel, and they end up having incredible economics, like 90+% contribution margins with that model. And that's totally unique. There's no bank that can say that. So that's number 1. Number 2, they have call optionality on what's been called the AWS of fintech with Galileo. So Galileo is the infrastructure player of fintech. It's infrastructure as a service. And when I dove into SOFI, I realized that SOFI is actually the digital shelf for all future Galileo products, which is really cool. It's like SOFI has built the super app, and all of the different APIs in that app can be productized and sold by Galileo to different fintechs like Robinhood or Toast or Chime, Verobank, Revolut, all those companies. So SOFI is super cool. Their CACs have been tremendous.
I didn't know SOFI had that much optionality. Like, that's crazy.
Yeah.
And then that also creates the cool network effects as well amongst users.
Right. Yeah. Network effects are huge in this space. I mean, Square, now Block, really popularized this alongside PayPal's Venmo, but peer-to-peer payments, huge network effects. SOFI doesn't quite have those network effects. I say doesn't remotely have those network effects compared to its older brother Block and Father Time, PayPal. But But it's a really cool company. It's trading at a ridiculous valuation. That's one I'm really excited about.
Quickly, before you dive into the other one, Tyler, what's your
Yeah.
thoughts on PayPal? Because we've had this debate this week with a few of my Discord members. What do you think of PayPal?
Yeah. I don't want to start any fights. I'm not a huge fan of PayPal.
I'm gonna let you finish.
I think PayPal is functionally like an incumbent bank at this point. I think they've acquired all of the innovative parts. So let me back up. PayPal, like the original PayPal, is the origin of all things good that is fintech, right? Peter Thiel, Keith Rabois, Max Levchin, like these are great founders, and the DNA of PayPal is fantastic. Elon Musk, right? Like the DNA of PayPal is fantastic. All of those people are gone. Everyone is doing something else. All of the DNA is gone, and all of the innovative DNA of that company these days has been acquired, right? They tried to acquire Pinterest. That failed. No one wanted that. They acquired Venmo, which is doing great, but they acquired it. They didn't acquire the culture and the leadership team that made Venmo what it was. And that's why Cash App is taking market share from Venmo. And I just think, I don't know. The last interview that their CEO did, he mentioned Super App 16 times. And I get it. I get what they're trying to do. I think that there are better stories and better growth opportunities in the fintech space.
I was reading. Don't go looking for him, guys. Don't go. I was reading about Hewlett Packard, HP. And their slogan was "Invent." And from 1991 to 1998, they went on an inventing spree. They were just they had a ton of creators putting their heads together and just inventing stuff. From the all-in-one, print, fax, copier. Then they just created, within that period of 6 years, they were inventing. And then, like you said, the DNA left, right? So they switched up the board. Okay, the creators, they were kind of getting shut out because, market cap, I believe, grew from like 8 billion to 123 billion, if I'm correct, within that 6-year period. So crazy, almost 10-bagger, returns for investors. But as soon as the DNA left, by 2001, the culture had shifted. They were no longer inventing anything. Instead, they went to a culture of just acquiring stuff, And then by 2003, the market cap had pretty much collapsed back like 20 billion or 30 billion. Again, they stopped inventing because the DNA of the company left. They were out. So when you're talking about PayPal now, that just reminded me of Hewlett Packard. Yeah,
totally.
I'm gonna let you go on to, was it Unity? Yeah.
I can do like a quick pitch for Unity. So I think Unity is like mini NVIDIA in terms of its positioning and opportunity.
Wow.
I've owned NVIDIA a lot over the years, and I don't think I've ever bought NVIDIA and lost money. It's like a Shopify, for the past 5 years. It's just one of those companies that just executes. It just does well. But the idea with Unity is that Unity is described as simply a game engine company. It just makes a game engine. But in all reality, it is so much more. So it has 4 growth engines over the next decade. Gaming is number 1, and that's something that's just going to get bigger and bigger. But the even larger opportunities are in things like industry, so architecture, construction, digital twins. They recently announced a partnership with Hyundai so that they can build models of factories with actual physics baked into the code, so that they can show how successful a factory will be and optimize it before it's built. Crazy stuff. UFC Metacast, so you can watch UFC in 3D, like hologram style, on your kitchen table if you want. So those are like industry opportunities. And then you get into things like AR, VR, which over the next 10 years is going to be a huge deal with hardware makers like Apple and Facebook leading the way. But all that content is going to be made on Unity. They're already the vast majority of AR/VR games are made on the Unity engine. And last but not least, of course, is metaverse, and this is the biggest of all bullish tailwinds, and just the concept that Internet 3.0. So we're going to be living much more of our lives in a digital capacity, and there's going to be much more flexibility with that experience. So it'll be part game, part entertainment, part leisure, part social. And all those features sort of are quilted together by Unity software. I don't think there are many companies in the world that are hiring more people and more focused on acquiring adjacent horizontal technologies that they can verticalize over the next decade than Unity. They recently acquired Weta Digital, which is Peter Jackson's like basement project. It was like a basement project to create like Gollum for Lord of the Rings that became the most dominant like artistic product in the world that's never been productized. So they have this team of thousands of engineers and artists that are using products that are state of the art that have never been sold to other companies. So Unity just acquired them, so they get all those artists and all those engineers, but they're also able to sell those products for the first time to other companies and use them in-house for their own creative content. They have fantastic net expansion rates north of 140%, which is truly elite, growing like a weed, always beat expectations. I mean, this is a fantastic company. They got huge tailwinds behind them.
Insane. Okay, guys, it's time we put Unity. If you haven't already, put Unity on your watch list, guys. Do your DD. But then again, I'll link Tyler's article as well. It's a lot more in depth, guys. And Jose here says as well, about interesting culture insight. Can you see his comment? So Earl was asking about Stripe, your thoughts on Stripe. I think Stripe, I mean, you sent me an article, like they don't really plan to go to IPO yet, like they're really happy private. And personally, I like Stripe. I use Stripe for my own business. What's your quick thoughts on Stripe, Tyler, if you don't mind?
Stripe is like a no matter what company for me. So Stripe, SpaceX, OPENDOOR, they're all sort of in that category of I would pay a lot to be an investor in those companies. So I'm a big fan of Stripe, the culture that they've been able to manifest. And that is an infrastructure play of infrastructure plays. Yeah.
Okay, so HT, I'm going to ask his question after when we talk about OPENDOOR. And then Jose is big on Unity as well. Jose is also very experienced within that industry, work-wise, career-wise. He's crushing it. And he's been talking about Unity a lot. Okay. So I'd love to see Unity drop more, own them before, but sold to buy other companies I thought were cheaper. Okay. Right. So, now let's go into the big boy. Okay. OPENDOOR. He said that's your number one child. That's your firstborn. Right. What's your bull thesis on? Okay. So how would you describe OPENDOOR to an 11-year-old in under 2 minutes or less, as Peter Lynch would say?
I think it's a little challenging to give the value proposition to an 11-year-old for buying and selling a home, but the idea is just, you can buy and sell a home on your phone, right? If you have a home and you have a phone, you can sell it. And so the concept there is you log onto the app, you type in your address, you take a quick video of your home, and then you will get an offer and you can close in 3 days or less. So it's a remarkable amount of innovation in what is otherwise a very slow growing real estate space. All of these innovators in real estate, all they've really done is made search more enjoyable, more of a delight, which is great. But the biggest pain points in real estate have always been the transaction. There have been some amazing statistics over the years talking about how people would rather go to a funeral or of a relative or get a root canal than sell their home again. I mean, it's truly a painful process. It's stressful and it's a lot of money, and there's no transparency, right? You never know. Did I get the right price? Did I sell too low? Did I settle? Am I in the right home now? right? And so there's all this friction in the buying and selling process that Opendoor came in to innovate. And so their concept was one that they could price homes sight unseen with a small degree of error. And I think that they've been able to demonstrate that they can do that. They've been really good at optimizing the seller side of the home buying and selling process. But over time, I think that they're going to continue innovating in the buyer side as well, and ancillary services. But when you think about the investment thesis for Opendoor, and I mean, I have a big one. But this is a company that is disrupting for the first time the biggest total addressable market in the history of the world. And you might see on investor presentations people saying, "Oh, my TAM is 2 trillion or 7 trillion," but those aren't real. Whereas Opendoor's TAM is actually 2 trillion plus today, and that's real. And they're a monopoly in that market, with Zillow bowing out. They have a fantastic leadership team, growing revenue 10x over the last 9 months. I mean, it's an absurd story that is vastly underpriced and misunderstood.
Okay. Bravo, by the way, bravo. I mean, smashed it. But with that said, the current sentiment, I think one of the major pushbacks you see online, and again, it's the margins. People are talking about margins, they're not happy with the margins being so tight, and now interest rates are going up, that's going to eat into margins. So now you're seeing a lot of bear articles being published just because of that. Are you concerned about that?
Yeah, so this is definitely falls in the camp of a misunderstood bear thesis, and I always welcome bear arguments against Opendoor, because oftentimes all we need to do is talk about it, and then it's clear, oh, that's not actually a bear argument, right? And interest rates, one of them. So Opendoor has a really unique capital structure. So when they buy a home, 80% of that home is not on the balance sheet. It's funded via debt, low cost debt, and they have the lowest cost of capital of any players in the space. So they only have 20% exposure to that home on their balance sheet. And so what that means is that if for every 1% rise in interest rates, and it would have to go up 1 more percent from here, which it's not anytime soon, you would only increase fees to Opendoor by 0.25%. It would impact their margins by 0.25%.
0.25.
So what I'm saying is, let's say interest rates go up 5%, which they won't. Opendoor's margins would go down by 2.5%. But Opendoor is able to flex their fees. They're targeting a specific margin in perpetuity, right? They're targeting 6 to 8% in perpetuity. And so if interest rates rise significantly, they will adjust their fees to cover those costs. And for the majority of Opendoor's life cycle, their fees have been greater than 10%, and they've still grown like a weed. With Zillow out, they don't have to race to the bottom for margins. And so I think if interest rates rose dramatically, they would just raise fees by a percentage point, and it would completely offset it.
I mean, Carrie Wheeler has mentioned this, I think, in almost every earnings call I listen to. Analysts ask her the same question, and she gives the same answer about margin. They're flexible on margin. They're able to readjust according to whatever the Fed does. But I think, again, because it's a business model, like you said, number one is misunderstood. Number two is disrupting an industry that's never been disrupted before. There's a lot of risk from that standpoint. And of course, Zillow exiting, I saw so many people on Twitter saying, look, if Zillow can't do this, no one can. Zillow has all the data in the world. I think we got in, I think there was someone commented like that. And I think it was a response to your comment that I just jumped in and to say something. I was like, yo, what are you talking about? But that's the sentiment, and as a result, the sentiment is overwhelmingly negative, and you can tell from the price action. I mean, I think someone was saying in the Discord this week that so far this year it's down another 21%. So it just makes it even cheaper to own, essentially, but you don't class these as risks.
No. I want to be clear. I think that they're headwinds, but I
Yeah.
wouldn't. They're not thesis killers.
Mm.
And people, when I first started researching Opendoor, the thesis was, oh, Zillow is going to eat Opendoor's lunch. It's a bigger company. It's got a great
Yeah.
brand. It has top of funnel. Its CACs will be lower. It has more
Yeah.
data. And
Yeah.
from the beginning, I've been saying that's just fundamentally wrong. I think my quote was, I doubt whether companies with self-serve ice cream stations and nap pods can truly compete with a company like Opendoor, because Opendoor forever has been predicated on these low margin businesses. Their business
Yeah.
survives and dies based on it. And
Yeah.
Zillow trying to come in with their 70 plus gross margin culture and say,
Yeah.
hey, we can do iBuying was just, I mean, it just was ridiculous. It's too much of a culture shift. I think they would have saved a lot more money if they just bought OfferPad instead. And to be honest,
Yeah.
the amount of money that they're losing on iBuying and the investment, OfferPad I think is cheaper and by market cap right now than all the money they've lost in iBuying. So
Yeah.
I don't know.
Yeah. Facts. Facts.
Yeah.
And I think that would lead me on to a question from HT then. He says, what makes you more bullish on Opendoor than OfferPad? Because I know there's another Discord member. OPAD is his larger position. And he says because he likes the steady growth with OfferPad. You know, they're not really expanding as crazy as, you know, Opendoor is. I mean, Q1, Opendoor was in like 27 markets. By Q3, they're in 44 markets. You know, like whereas OfferPad, they're taking their time. They've got clearly they've got better margins. So in terms of a risk point of view, of course they're not the leader, but you
Yeah.
know, I understand why it's chosen OfferPad in that sense. Like, what makes you more bullish then?
Yeah. So a couple things. Opendoor and OfferPad have pretty similar margins. I think it's like a 0.1 percentage point difference in margin in Q3, and that was the only quarter. In Q2, they were both the same. And then Opendoor has been higher than OfferPad pretty much every other quarter in existence. And Opendoor also makes more money per home than OfferPad, and part of that is because they have a higher average home and more ancillary services than OfferPad. And so even if the margins are about the same, Opendoor makes more money per home than OfferPad. So it's a much more profitable company than OfferPad at baseline. So we've got that point. I mean, that's unit economics. You can compare them, but anywhere you cut them, Opendoor is more profitable. But the most important point is Opendoor is growing multiples faster than OfferPad. I think OfferPad is 190% year over year, whereas Opendoor is 10x in the past 9 months, like I said. So I think let's say Opendoor slowed down to 190% to be growing at the same rate as OfferPad. They could selectively pick and choose which homes they think they'll get the greatest return on, sacrificing conversion for profitability in that situation. They could easily do that and make a ton of money doing it. But the thing about data and artificial intelligence in particular is that it compounds like a dividend investment. Data and artificial intelligence compounds every day with every data point. And so Opendoor isn't just chasing the opportunity, but it's chasing the data advantage that this monopoly will give it, because every home, every 10 homes that it acquires versus OfferPad's one, that's 10 additional pieces of data that's going to compound and improve their algorithms, improve their operational execution. As they scale, they're going to gain many more contractors. Their cost of capital will be much lower than OfferPad. Their cost of contracting and subcontractors going in and doing their work to lightly refurbish homes is going to be much less than peers, because it has the scale economies moat. I think all of these things will continue to manifest over the coming years as Opendoor continues this crazy scale. But I just think if we're looking at them now, OfferPad is going to be fine.
Yeah.
But if you're bullish on the space, go with the leader. Go with the one that's chasing this crazy opportunity, because that's where you start getting 10 plus bagger returns, not the other way.
Yeah. Yeah. Connor says Yeah, the more he researches open, the more he loves it. Yep, Joshua's fires.
Me,
Yeah,
me
slowed down
too.
to 180% growth. It's an unbelievable statement. It's so true. It's true. And that's a great point. I didn't even think about it like that in terms of AI and data point, like just constantly improving the algorithm, the more they expand. And actually that brings me on to my next point. Obviously, OpenDoor announced that they're hiring in Canada some engineers, obviously hinting at expansion into Canada, which is. I wanted to get your thoughts on that. Do you think that's too soon? Because look, I've read many companies that have imploded because they've tried to expand too quickly, right? I mean, like, let's dominate home first before we go and try and take over our neighbor's home. Do you know what I mean? So,
Yeah.
what's your thoughts on them looking into Canada, hiring engineers? What's your thoughts on that?
Yeah, I think it's curious.
Yeah,
I was thinking about this the other day because every market is unique, right? And
yeah,
so you can have the bare bones and the basic, the basic playbook in place, including a lot of the software to help optimize launches in new markets. And we saw that this past year, OpenDoor was able to launch 6 markets in one day.
yeah,
And so clearly they've been able to decrease their threshold for software and operational requirements to enter a new market. And so they're getting better at that sort of across the board. But the area of the United States that they haven't brought their technology and their services to yet is the Northeast. Cold areas that don't sell well during the winter, where people just castle up and
yeah,
don't do much. And I think Canada is obviously not, it's not balmy. It's a cold environment as well.
yeah, yeah,
And so it's interesting that they're doing that, but at the same time, iBuyers are popping up around the world, right? You have BEKE in China. You've got Loft in Brazil. These companies that are trying to do a similar thing, and OpenDoor benefits from scale and obviously those understandings and those learnings from launching in so many markets.
yeah,
I think with Zillow out of the picture, there's less pressure to have their foot on the gas pedal so much and more
yeah,
focus on prudent economics and a careful migration. I mean, going back to the Uber example, Uber was super aggressive in the beginning, and that was very helpful for them. OpenDoor was very aggressive in 2021, and it
yeah,
worked out, right? Like they
yeah,
built all the
yeah,
infrastructure that they needed to scale 10x, and they did.
yeah, yeah,
Um, I don't see them slowing down too much. I mean, I have them. I'm modeling for 3x growth in 2023. In 2022, which I think is probably a bit conservative, to be honest.
yeah,
I've only ever had to revise earnings higher. It's like every time I see what I wrote about OpenDoor like 6 weeks ago, I'm like, oh wow, they've really revised guidance a lot higher than that since then.
yeah,
Um, but I mean, I don't know. It remains to be seen. I think that they can iterate more slowly as a
mm,
consequence of Zillow being out of the picture, which may be like a saving grace. They don't have to just go in and buy 500 homes and start selling and doing the best they can. I mean, they can take their time and learn more slowly.
yeah. Okay. In terms, so you mentioned about modeling, right? And again, another bearish argument is, oh, they don't make money. Like they make all these billions and they don't make money, right? So and they're not profitable. How would you? Don't get me wrong. I've seen how you reply to them. Those bear arguments on Seeking Alpha. How would you like if someone looks at the blank check, you're looking at the income statement, you see negative, write off. Like what's your thoughts on that then? And when do you model them being profitable?
Yeah.
Yeah.
So I'm not invested in a single company that's profitable today. I think that that's sort of part and parcel if you're invested in disruptive growth companies,
Yeah.
and you want to be early. Um, OpenDoor is probably the closest company that I'm aware of that's publicly traded. That's like a VC opportunity.
Mhm.
It is like it's a misunderstood model, growing at preposterous levels that have never before been seen in the public market. And I've been early on it this past year. The one difference is we don't have the benefit of those awesome subsequent rounds where the valuation balloons back up. But I do think in terms of the return potential, I mean, it's huge as a consequence of how it's undervalued today. But you're kind of asking more about profits. What I would say is, if you exclude stock-based compensation, Opendoor is profitable this past quarter. And so clearly they can buy and sell homes and make a profit. You know, that is despite the fact that they originally guided for profitability in 2023. So they did that 9 months after they guided for something that wasn't going to happen for 2 years. So I think that's a positive. But the second thing I'd say is 2021 was a scaling year. Like, they were trying to get back to 2019 from all the COVID pauses and sell downs of their inventory that they had to undertake. As they gain increasing scale and they start doing 5 billion a quarter in sales, which I think will be Q2 of 2022, their gross profit is going to be 500 million a quarter. I mean, that's a very profitable company. By 2023, they're going to be minting money. It's going to be $1 billion in gross profits a quarter by 2023. I mean, that's absurd.
That's what you're modeling, 2023. Okay, so the next question, again, another pushback you might get is, okay, obviously, what if the market slows down? Because, you know, a lot of people are scared that the real estate market might crash. I personally don't see how that's going to happen, because if you just spend 5 minutes looking at the supply and demand data, I just don't see how the real estate market will slow down. Yeah, the people are saying interest rates go up, they might slow it down. But it might slow, that's fine. But in terms of crashing, I don't see how it's going to happen. Are you concerned about a crash in the real estate market?
Yeah, so a couple things. Let's say home sales slow in the United States, right? So there's 6.5 million homes sold in 2021 in the United States. Opendoor captured about 1% of that. So if it's growing, 1,000% a year and 90% sequentially, pretty much every quarter, that tells you that it hasn't reached saturation, right? And so the only players who are going to be affected by a slowing housing market are players that have saturated the market. And so players that only have 1% that are growing much faster than the decline is happening, I think it'll be a blip of a headwind for Opendoor. If Opendoor had 70% of the market and we had a 20% decline in the number of homes sold, that would be a headwind. But while it's just trying to get up to a reasonable market share, I don't see that being an issue at all. And then you had a question about, like, if home prices go down. Loop Ventures did a really interesting piece on Opendoor talking about how slowly home prices move. And so they found out that over the past 188 quarters, only 10% of them were negative for home prices. So in only 10% of the last nearly 200 quarters were home prices negative over a 3-month period. And even in that, the number of times that home prices fell 2.5% in a quarter was only 5 quarters. So like 5 out of 188 quarters where there are price declines of 2.5%. They move at glacial speeds. And Opendoor only has exposure to those assets for 90 days or less on average. And so that's really important to internalize that risk, right? So in a market like a black swan event, like one of those quarters where home prices move 2.5% or lower, like the 2008 financial crisis, and I'm including the 2008 financial crisis here. What you find out is that Opendoor can again raise fees because people are not going to want to sit on their homes on the public market for months and months and months in a down market. They're going to want certainty, speed, and simplicity. They'll pay a premium for liquidity.
Damn, I didn't think about that. Damn.
That's what this is what I'm saying, man. Like, all the bear arguments. I'm like, yeah. Feel free to stop by. We can talk about the bear arguments.
That's I didn't even think about that, because it's true. I remember, obviously, I was a lot younger during the crash in 08, 09. And I remember like one of my dad's friends. I mean, he had like 11 houses, right? That he got. It was so easy getting houses, and like when it was crashing, he just wanted to get rid of them ASAP. Just find a buyer, because he was panicking. Obviously, you're panicking, and then
Sure.
the whole process of selling. You touched on a lot of the pain points. Who would you turn to in a situation, in a circumstance like that? And that's going to boost revenue. It's crazy, right? Okay. I didn't even think about it like that. Snap. That's good.
Bull fuel.
Yeah. Okay, so I read I think it was an article from Bloomberg talking about the number of clients for OPENDOOR and OPAD were corporate clients. I'm not sure if you read that article, and obviously, again, misunderstood. They painted it in a bare nature, stating, "Oh, it's pushing out the first-time buyers, pushing out families because they're selling to corporates." What's your commentary on that?
Yeah, I think obviously not a great look was painted by that article. I did read it.
Yeah.
So a couple things. Number one, so there are just as some backstory. There are more realtors in the United States than homes currently on the market, right? So talk about a massively fragmented industry. And I think fundamentally there's an incentive misalignment between a realtor and a home buyer and a home seller. And this is a charged topic, but maybe as a counterexample, you can think of a headhunter, right? So someone that's hired to find someone for a job, right? Like an executive headhunter. It's the same situation. There's a misalignment of incentive because that person's trying to get someone hired because then they get their commission, right? It doesn't matter if that person does a good job. It just matters if that person was hired. It doesn't matter if that home was sold for $3,000 more. It just matters that the transaction happened for a realtor.
Get that commission. Yeah.
And so there's a large number of people, millions of people who have this job who are currently feeling like their job is being displaced and automated by technology like OPENDOOR offers.
Yeah.
And I think what we'll see is a transformation of the position of a realtor from more operator and negotiator to advisor, to consultant. And I think also their services are going to shift towards the higher end of the market where iBuyers don't have as much integration at this point. But all of that to say that there are plenty of people with large networks that are already beginning to insert negative sentiment about the iBuyer position. The other thing that I think more directly answers your question is that liquidity providers always boost value for a marketplace. Always. Yeah. They always do. Yeah. They always will. And so you can say it's very easy to say the soundbite of OPENDOOR sells to corporates who are displacing individuals, and then that community isn't able to get into those homes. That's fine. But at the same time, when you have a liquidity provider, you have a huge value proposition for people that are trying to move more quickly or purchase the home of their dreams. These are all opportunities, not just in a raging hot bull market, but also in a bear market like we talked about. Those opportunities won't be available to those people without a company like OPENDOOR. And Keith Rabois, his entire job at PayPal was basically lobbying with, I mean, not his entire job, but one of the things that he's better at than just about anyone is lobbying for regulation. And he prevented the demise of PayPal in a lot of ways because he found ways to demonstrate the value of PayPal. So I think that there are very few people that are better positioned than him to help mitigate regulation in the space. But either way, I don't know. I think it's obviously a very, very biased piece. Yeah.
And I think as well, if you are invested in OPENDOOR, you got to expect that going forward. Any disruption that takes place, you're gonna have negative articles, negative bearish sentiments, short seller reports. All of these things I think are ahead, not behind OPENDOOR until they prove their business.
look at taxi drivers in response to Uber, look at
Uber,
hotel
yeah,
hotel
yeah,
employees in response to Airbnb. I mean,
Airbnb,
it's the same thing. Anytime someone's wallet's going to get lighter as a consequence of technological disruption, I
yeah,
mean, it's understandable, right? Like if someone
yeah,
came out tomorrow and they're like, I've got a robot that can operate by itself without you, I would be like, well, they probably don't have the intelligence and the creativity to. I'd be saying the same thing, right? I would have the
yeah,
same concerns,
yeah,
and that's a very rational
yeah,
human response.
yeah,
And so,
yeah. Get
it's totally
defensive, yeah.
understandable.
Yeah, yeah, and I think for open door investors in the chat and or watching the stream afterwards, just factor that into your investment thesis that is to come. Tesla's, I would say, is about to come out of it because obviously regulations are now shifting in favor of Tesla. But I mean, like Elon Musk got it from all angles. That's a perfect example. So yeah, like it's people's pockets, man. People's pockets are gonna get hurt, man. No, these realtors, there's gonna be a lot of realtors that are gonna be out of a job very as open door expands, yeah, it's gonna hurt. It's gonna hurt. Right. Tyler, you smashed it, brother. You smashed it. I know I just clocked the time. We've actually gone over an hour already. Right. GWB, if you have any questions, now time. HT, I'm not gonna ask your question, brother. You already know, bro. We're not talking about sexy averages here. No, it's long term. But yeah, Connor says I could see Open acquiring. Would they? Do you reckon they could acquire OfferPad? Are they interested in acquiring OfferPad, Redfin? I don't
I
know.
think I think the internal. This first part of my answer is totally speculative, but
Yeah, yeah,
it's based on things I've seen Open Door employees say over Twitter. I think Open Door has a pretty negative perspective on the capabilities of OfferPad relative to them. Negative might not be the right word. I don't know what OfferPad would add to their service, right?
yeah,
They're doing fundamentally the same thing, and
yeah,
in my opinion, Open Door is doing it better.
yeah,
An integration with Redfin makes more sense to me, and they're already partners in a few areas. And
yeah, yeah,
Redfin cannot do iBuying for much longer. They're losing a ton of money doing that. So, in Redfin's super cheap now. I think it's like four or
yeah,
five billion dollars maybe in market cap.
yeah.
So as Open Door scales and starts getting the valuation it deserves, it could potentially add top of funnel approach there. Yeah, consolidation is always a possibility.
Yeah, I was gonna say, yeah, they already have some existing partnerships with Redfin. Redfin now, I think it's gonna, yeah, I think they're just gonna slowly phase it out. I don't really see that expanding. What about a partnership with Zillow? What if Open Door was to announce some? Would you be all right with that? I personally, I didn't mind it when I thought about the idea, and we've discussed it in the Discord before. I think that it will be in Zillow's best interest, I think. But I think Open Door can survive without it. But I think that might like catapult Open Door if they were to come to some sort of, like all of Zillow's listings. There could be like an offer, like I buy an offer. What's your thoughts on that?
So it's an interesting question. If you listen to Rich Barton, CEO of Zillow, talk about entering iBuying in 2018, that's what he came back to Zillow to do. He wasn't with the company at the time. He came back to CEO to make this the Zillow transformation into an iBuyer. And when he described the reasons why he wanted to go into the space, it was because he realized that if Zillow didn't go into iBuying, they were going to be displaced by the iBuyers. And the reason for that is because Zillow makes search better, right? And the Zestimate was this really sexy tool that you could look at your home price, but it turns out that that's not actually your home price. The only one who has a home price is Open Door. And so as Open Door scales and starts owning tens of thousands, if not hundreds of thousands of American homes, it has the marketplace and it can be elevated, right? And by that I mean you can click buy it now, right? So it becomes Amazon in that situation rather than Google. Google is just search, but Amazon is where you can actually elevate it to a buy it now experience. And Open Door won't really need Zillow in that situation because it's going to have top of funnel, because it has thousands and thousands and thousands of homes that consumers can surf, buy, or sell.
I did not know that's one of the reasons why Rich Barton returned back to Zillow to try and steer the company in this direction. Okay, so wow. Okay, I didn't. That was a revel. That's new. I need to check. I find that interesting to check that out. So now
I like. What's that? I was just going to say. I like this question about Latch. Collaborating with Open. That's interesting. I mean, that's like the second generation of OPENDOOR and high margin ancillary businesses. I don't know if they're 100%, if there's 100% synergies there, because I'm pretty sure Latch, and I don't know this one as well, but I read its investor presentation back in the day and thought it was a winner. But I think Latch also has corporate buildings and like office buildings and things like that, which OPENDOOR isn't involved in. But prop tech is a huge opportunity. Access and security are huge opportunities for OPENDOOR. I mean, the idea that every time OPENDOOR buys a home, it can outfit it with technology or licensing deals, like outfit the whole home with Amazon Fire Alexas, or outfit the whole home with Sonos speakers or something like that. You know, like these are opportunities that no one else has these opportunities, and it would be so easy for them to make those kinds of deals. And that's like the ultimate bull thesis for OPENDOOR is, what is its AWS? What is its cash cow? And I mean, they're gonna revolutionize the space.
Damn. Okay, guys, everyone take a deep breath, or is it just me? I think it's just me. Let me just take a deep breath. The potential is crazy. Right. Okay. So Connor asked for your opinion on Intel and their new shift in the business model. There's been a lot of changes in Intel recently. Not sure if you're familiar with some of the changes, Tyler.
I actually don't cover Intel. I'm sorry, Connor.
Yeah.
I'm disappointed too.
Connor, don't thumbs down the video, bro. I know. Don't thumbs down the video. I'm joking.
Sorry, Emmanuel.
What's your opinion, bro, on HIMS? Do you have any? Do you know HIMS? Andrew?
Yeah. So actually, I started looking into HIMS because of your, you've been posting about HIMS a lot, and so I've been taking a look as well. I think it's an interesting one. I'm like, so a couple things. I'm a little wary of consumer products, just because, that to me is not necessarily fit my investing criteria. I do think they're doing some cool things in telemedicine, and I would be more excited about it were it not my terrible experience with TDOC as an investor. But I think it's a super cool company, and it's doing a lot of great things. Love the commercials. And I'm gonna be watching for sure. I follow it now on my Seeking Alpha page, and I read all the articles about it. I think Riato just did an interesting article that I really enjoyed. But yeah, I mean, it's growing very fast, and there's a lot of optionality with it's got the HIMS and hers now. I mean, it's cool.
Yeah. I really like their marketing. They're very big on TikTok, because obviously that's the target market, millennials. And when you listen to Andrew Dudum speak, talking about visionary leadership, he said he doesn't really compare himself with TDOC because their target market are millennials, the up and coming generation. He wants to grow. The company will grow with them as they grow, depend on their services. Key business model, valuations right now silly, rapid growth.
Silly.
Yeah, I'm quite bullish. And again, it's another company that there's no debt on the balance sheet at all. All cash. I'm bullish in HIMS as well. So in terms of TDOC, what did you mean? I just wanted to touch. You mentioned something there. Your experience with TDOC as an investor. Well,
I think. Well, it's funny because if you're an OPENDOOR investor, SOFI investor, Palantir investor, the past couple of months have been hard. And it's tough to like wake up and see these prices. TDOC has been like that every day for the past year. Like it hasn't had a good day for the past year. You know what I mean? So I think I actually thought I got into TDOC at a really reasonable price, like right under right under $100, and
Yeah.
I was like, this doesn't even make sense for the intellectual property and the assets here. And like I said, I'm more of a patient investor, and I'm happy to
Yeah.
hold long
Yeah.
term. But just you look at the chart, and it's like, how did this happen? It's doing great. Like the company's
Yeah.
doing great, but every time they release information, it just gets crushed.
Gets crushed constantly. I got in a small position, a tiny position, in the 90s, and I thought, yeah, you know, I'm not. No one can time the bottom. Facts. That's a
Right.
fact. No one can time the
Right.
bottom. But I thought at 90, it was getting really silly because I mean, if you look at their acquisitions and now what the value is, it doesn't even make sense. It just doesn't
Yeah.
make sense. And then it dropped to 8. I was like, what is going on? You know,
Yeah.
I don't. I think part of it is to do as well with Kathy Woods. I think, like the Wall Street do not like her. You know,
Yeah.
she actually she threw mud in their face in 2020. You know,
Yeah.
she was right on Tesla, and she was the only one really talking about a V-shaped recovery, whereas all of them, you know, they pretty much they were wrong, and Kathy was right. So I think there's this extra hatred towards Kathy Wood stocks, and you know, now throughout 2021 she was being scapegoated a lot, and again they're looking at her again. So I think because TDOC's like, aside from Tesla, that's the second largest position. You know,
she just continues to buy TDOC.
yeah,
To be honest, I am a big fan of Kathy Wood, and I think
yeah,
she's an innovator. And I was really sad to see her sell OPENDOOR and Palantir, and
yeah,
then now she's
yeah,
buying some more Palantir, and I think she sold off all of her Zillow.
yeah,
But I think that it's actually the opposite, or at least it was for most of 2021. Like if she bought a company, it was going to go down. It was like that company was
yeah,
marked for dead. Whereas if she sold the company, it was like, okay, now it's our time to buy. I
yeah,
think Wall Street just has a collective agreement to just be like, whatever she buys, let's put in the crosshairs.
yeah, yeah. And I mean, it's great for the long-term investor, as you said,
Yeah,
because it can't be like this forever. You know, it
right.
can't be like this forever. You know,
I'm
eventually,
bullish on Teladoc.
yeah,
I'm
yeah,
gonna hold, and I
yeah,
haven't lost any conviction. It's just like a painful
pain,
painful
yeah, yeah,
situation. Yeah.
yeah. It's like an itch that won't go away every weekday.
Yeah.
um. Okay, so Tyler, Okay, so yeah, you haven't lost conviction. That's that question. Yeah, yeah, and yeah, my brother's there saying about mental health, the category that HIMS got into as well. It's growing, and yeah, it's not slowing down. So Connor has the last question. It says, "Do you cover any cybersecurity firms? Is there one that stands out to you that has a moat?" Great question.
Yeah. Yeah, great question. So cybersecurity firms is like on my scale of misunderstood companies, cybersecurity firms are like the most understood companies in all of Wall Street. They get the highest price of sales multiples.
Yeah,
They get credit for everything. They're all
yeah,
trading at obscene valuations relative to everything else. And so
yeah,
it's like an EV company for me.
yeah,
Like I get it, but I don't invest in them because they're the opposite of a broken stock. They're broken in the wrong way. They're broken in like a overvalued way, in my opinion, compared to some of the opportunities that I think are available in these misunderstood companies. So I think there's huge optionality in
yeah.
those companies. They're going to do really well, but it just doesn't fit my investment criteria because I think that they're already fully priced.
Okay, top man, top man.
Sorry, Connor.
You've hurt Connor's heart twice now.
I know.
No. Connor's a good man. He's a good man. But Tyler, bro, thank you so much, man. I think we're gonna wrap it up. I've taken too much of your time. I wanted to take 1 hour. You've been generous with your time. We're going up to almost an hour 20. Really, really appreciate you, brother, coming on. And just sharing knowledge. And Connor said, Tyler said he's happy to do this again. Hopefully, hopefully
Yeah.
you still are. But no, I've loved it. I've really loved it. I've really enjoyed it. Do you have any other things as well, Tyler, you want to say before we?
No, I
Close?
honestly
Yeah.
thanks so much. I
Yeah.
told you this beforehand, but at my day job, I really don't get to talk finance like this.
Yeah.
In a lot of my writing process, I don't have an editor or someone I share notes with. It's all private. Not because I want it to be, but just because I don't really have a lot of people in my life that are very financially strategically oriented. So this is
Yeah.
it's a tremendous
Yeah.
amount of fun. I love doing this. I love going back and forth on the bear and bull case. I love the community. Like, this is super cool that you've been able to build this and have all these people here. So thank you for listening. I had a blast.
Yeah. No, thank you. And guys are showing love in the chat as well. Hey, the GWB family, the community is strong, you know, and like we're all about, we've evolved where we want to learn, you know, and grow our wealth together, and face the challenges and play this game together and build wealth. And, you know, just education is key. I try to make education key now. Before, it was about, you know, trying to get profits, gains, and, you know, swing trading, this, that. But now we've really converted, and I think that's just given us a solid foundation to build off, and where we can have someone like yourself come and just drop gems, man. You dropped so much gems today. So appreciate you, brother. I appreciate you, GWB. I appreciate you guys for showing up. Some brilliant questions there. And yeah, so we're going to wrap it up here. Guys that are catching it after, if you have any questions as well, you're watching the replay, drop it in the chat. I'll let Tyler know as well. But yeah, thank you guys. Have a great evening. So I can't lie, buy more open on Monday. All right, guys, take care. Bye.
All right, see you later.